Professor Shomu Mukherjee. Sir is an assistant professor in the Department of Commerce of Maharaja Monindra Chandra College. Good evening, students, and we also are very grateful that on this pandemic situation where teaching and learning method has shifted to the online mode, and with the support our respected principal, Madam Dr. Moshumi Singh Sengupta, and our respected departmental in charge, Dr. Ashit Kumar Mondol, and with the support of our governing body of THK Jain College, the Department of Commerce has organized a student enrichment program for the learning session, and as a learning session for the students of commerce. For the today's lecture session is for the third semester students, and sir will be delivering the lecture session on financial accounting 2. Let me just introduce you with Sir. Sir is the faculty member of Department of Commerce of Maharaja Monindra Chandra College. Sir has an overall teaching and research experience of more than 15 years. Sir is working as a guest faculty in the Department of Commerce, University of Calcutta. He is also associated with the Institute of Chartered Accountants of India, Institute of Cost Accountants of India, and many other esteemed institutions in various capacities. Sir has completed his graduation and post-graduation studies from the Department of Commerce, University of Calcutta. He has been honored as a silver medalist from Goenka College of Commerce and Business Administration, and was placed in the University Merit List at the post-graduation level. He has also completed his MPhil from the SAID University. Sir has acted as principal investigator in the UGC sponsored minor research project. Presently, Sir is pursuing his doctoral studies from the Department of Commerce, University of Calcutta. Sir has authored 5 books on accounting, 4 of which are published from Oxford University Press, and rest is from Pearson Education. Presently, these books are the recommended books list of many universities across the country. He has also contributed in many journals and presented papers in different seminars at national as well as international level. Moreover, he has contributed in many peer-reviewed journals at national level as well as international level. Sir has worked as a reviewer of various national and international books. His research areas of interest includes earning management, financial services, accounting standard, banking, risk management. Sir, we welcome you at our college on this evening, and we express our deepest gratitude for your presence at our esteemed institution. Now, I request you, sir, to start your session for and behalf of the beneficial interest of our students. Thank you, sir.
Thank you, Shunita. Thank you for your kind words. It's a privilege for me to deliver the lecture in these esteemed institutions. I'm really thankful to Principal Madam, Dr. Moshumi Singh Sengupta, Ashit Kumar Mondol sir, and you also, Sunita, for inviting me to deliver the lecture for the students. So students, let me tell you that it should be an interactive sessions. I want to highlight on the certain important aspect of the dissolution, especially in the case of the insolvency. Okay, so let me share my presentations with you at first. I hope the screen is clear to all of you. Now, let me start with the dissolutions of a firm at first. Now, what do you understand by dissolutions of a firm? That we have going to understand at first. What I am telling you, a concern when established, they are going for a unlimited life. Their life is not limited. This is one of the accounting assumption, that a going concern assumption. A concern will not stop its business in near future. But practically, it's not feasible always. A concern cannot run for numerous number of years. It may ceases its operation. When it's are going to winding up its business, first you have to stop its operations. they have to sell their assets. Whatever money they are getting by selling the assets, they have to pay their dues or obligations. And finally, the important facts relating to the accounting that I want to introduce, they are going to close their books of accounts. So first of all, dissolutions of firm. In the accounting that we mean, we are going to close the books of the accounts. This is point number one. So you have to square up all the accounts. This is the highlighting point. Now, how to square up these accounts, that we are going to focus. Now, what do you understand by dissolution, students? Any idea that you have? Please tell me. What do you understand by dissolutions? Any idea, student? If I am asking you that dissolutions means this, what is that? The official act of ending of a company. Harshit, we are talking about partnership. In the semester 3, we have only partnership. So I am asking about the dissolutions of the partnership. Okay. So we should not speak about company right now. Mampi Prasad is saying winding up of company, terminations. Actually, if somebody is asking about the word dissolutions, my counter question to them will be, is it about the dissolutions of the firm or dissolutions of the partnership only? This is the point. What I am highlighting, dissolutions may be of two types. Number one, dissolutions of partnership. Second one, dissolutions of firm. What is dissolutions of partnership, sir? Students, dissolutions of partnership refers change in the constitution of the partnership. Change in the constitution of partnership. What is that, sir? It may be on account of admission of new partner. It may be on account of retirement come admission, change in profit sharing ratio. So the firm is not getting dissolved, but there is a change between the agreement among the partners. That is termed as dissolution of partnership, where there is a change in the constitutions among the partners itself only. Whereas dissolution of firm denotes winding up of the partnership firm. So the firm will not continue its operations in case of dissolutions of firm, not in case of dissolution of partnership. So I made my heading partnership accounting, dissolution of firm.
Sir?
Yeah.
Sir, once more you will be presenting the screen. The screen is not being presented.
It's not
Sir,
clear.
stop the presentation and
Just
again
a
represent it.
minute.
Sir.
Now is it clear?
Yes, sir. Now it is okay.
So I am talking about two types of dissolutions. One is dissolution of partnership. Second one is the dissolutions of firm. Dissolution of the partnership refers change in the constitutions of partnership. That means the firm is not going to dissolve. The firm is not going to dissolve. There is a change in the agreement among the partners. It may be on account of admission. It may be on account of retirement. It may be on account of retirement come admission. It may be on account of death. It may be on account of change in profit sharing ratio. But the firm will not stop its operation. But dissolutions of firm refers that it is only in case of winding up of the business of the partnership firm. That firm will stop its operation. The firm will cease to exist after the dissolution. Any query, student? Any doubts regarding the first 2 points? Any doubt? I think for answering this, you can, okay, no. You can unmute yourself also to answer my queries, okay? And you can ask also if you have any doubts directly, okay? Now, shouldn't the screen is clear to you?
Yes, sir. Yes, sir.
Now I am coming to the accounting part. Now, how to do the accounting of a dissolutions of a firm? Actually, basically, it has been governed by the Indian Partnership Act 1932. This is point number one. It has been governed by Indian Partnership Act 1932. What you have to do? I mentioned 6 sequential steps. You have to follow these 6 steps to close the books of accounts. As I told you, the ultimate objective is closing of the books of the firm. This is the objective. This portion is the objective of you. This is the objective. You have to close the books of the firm. So in order to close the books of the firm, you have to follow these 6 steps. 6. Okay. First step, you have to close the asset side of the balance sheet, the items which are appearing in the asset side. Number 2, the items which are appearing in the liability side of the balance sheet. You have to sell the assets, and in respect of that, you have to record that. That means how to record for the realizations of assets. Now, whatever the money that you are getting by realizing the assets, you have to settle your external liabilities at first. You have to discharge your external liabilities at first. In the event of dissolution, you may incur certain amount of expenses, and you have to account for such expenses on dissolution. And last, rather most important point, you have to settle the amount due to the partners. So these are the 6 steps. You have to close the balance that is appearing in the asset side and liability side. This is 1 and 2. You have to make the entry for realizations of assets. You have to make the entry for payment to the external liabilities. You have to account for the dissolutions expenses. And last, rather the most important one, how to settle the amount due to the partners. Now, in respect of this, primarily 3 accounts are required. 3 accounts. First one, realizations account, which will help you how much the profit has been generated by the firm or how much loss that has been incurred by the fund in the event of dissolutions by realizations of asset and settlement of liabilities. Now, this realizations account is also known as dissolution account. Okay, there are 2 synonymous, two names has been simultaneously used. It is realizations account or dissolutions account. As per the item available in the balance sheet, you may open cash, you may open bank, or you may open cash book. Okay, if the cash account is appearing in the balance sheet, you have to open cash account. If only the bank account is appearing in the balance sheet, you have to open the bank account. If cash and bank both are appearing in the balance sheet, you have to draft a single column cash book. You have to prepare partners capital account. These 3 accounts are required generally, but my topic will be more towards the insolvency cases. If the partners are insolvent, in certain cases, you have to draft the deficiency account. You have to draft the deficiency account. Okay. So you have to draft the deficiency account in the event of insolvency of partner, in the event of insolvency of partner. Now, I will come to that part later on. I just want to brief down 1 to 6 point at first. The items which are appearing in the asset side of the balance sheet, like land and building, plant and machinery, goodwill, patent, trademark, copyright, debtor, stock, whatever the items appear in the asset side of the balance sheet, I have classified this into 4 parts. 1, 2, 3, 4. Number 1, cash and bank balance. Number 2, overdrawn balance of the partner's capital. Number 3, any accumulated loss. Number 4, other accounts. So I mentioned 4 types that can appear in the asset side of the balance sheet. Cash and bank. Number 2, overdrawn capital balance. Number 3, accumulated loss like PL account debit balance. And last, the other accounts. Now, all other accounts like land, building, plant, machinery are to be transferred to realizations account irrespective of the status, whether they have sold in the market or taken over by any partner, or it has not been sold off. It has been transferred to realizations account. This is point number 1. Any provision is created on such account, like I am telling you, in the asset side, debtors balance is given 1 lakh. From that, there is a provision for doubtful debt, 10,000. 1 lakh, the gross amount of the asset is to be transferred to the realizations account debit side, and debtors account is to be credited. And the provision that has been created on such debtors in the earlier year or years, that is to be transferred to the credit side of realizations account. Okay, that is to be transferred to the credit side of the realizations account. So I repeat this point: if any assets is appearing with its accumulated provisions, Then assets account is to be transferred to the realizations debit side, and its provision is to be transferred to the credit side of realizations account. Now, cash and bank account, we have to prepare a separate account. We have to open a separate account for cash and bank. It may be in the form of cash book, or it may be in the form of cash account or bank account. This account is to be opened in order to record all the transaction involving cash during the process of dissolution. Third point, if any overdrawn capital balance is given, then it is to be transferred to the debit side of partner's capital account as to balance brought forward. Any accumulated loss, you know that the partners are responsible for losses. So such accumulated loss are to be distributed, or rather are to be shared by the partners in the profit sharing ratio. So as it's a loss, such loss has a debit balance, it is to be credited, and partners capital account is to be debited. So these are the 4 items relating to the asset side of the balance sheets. Whatever items that is appearing in the asset side, irrespective of the fact of their transaction in the process of dissolutions, you can pass these 4 entries. That I can assure you that. You can pass these 4 entries. Okay. No need to go for any further adjustment. Before starting any adjustment, you can go for this. I'm coming to the liability side of the balance sheet. So my point number 1 is over. This point is over. This point is over. I'm coming to the closing of the accounts appearing in the liability side of the balance sheet. Now you see what I'm telling you. In the liability side, you can see partners capital account credit balance, that is like the capital account having credit balance is appearing in the liability side. Partners current account, any accumulated profits and reserves, and external liabilities. These are the 4 items. Okay. Now you see, students, if the partners capital account debit balance that is appearing in the asset side, we are transferring to the debit side. So it's very normal. Partners capital account is to be transferred to the credit side. Any partner's current account appearing in the balance sheet, it implies the firm, the partnership firm is maintaining its capital. The partnership firm is maintaining its capital under fixed method. Okay. So that means there are 2 accounts, capital account as well as current account. This fixed capital method, if is maintained by the partner, then the current account will only appear in the balance sheet. But at the last stage of the firm, this current account is to be transferred to whom? To the respective partner's capital account. So partner's current account debit to partner's capital account. Any sorts of profit that is appearing in the liability side, like reserves balance, like PL balance, or any other balance reflecting the profit, it is to be transferred to the partner's capital in the profit sharing ratio. And the most important, please, I need your attention. Any external liabilities account is to be transferred to realizations account, provided, please listen to me, I need your attention, students, provided the firm is not insolvent. I repeat the word. All the liability accounts are to be transferred to the credit side of the realizations account, provided the firm is not insolvent. I will explain you the term, what I mean by the word firm is getting insolvent. Okay. A firm is said to be insolvent if all the partners are not solvent. If the all partners are rather insolvent, then what I mean, then the firm is said to be insolvent. And if the firm is said to be insolvent, then all the liabilities account are to be opened separately. Okay. So tell me, any doubts do you have regarding this or not? Any query? So I just mentioned 4 points regarding the liability side. First one, how to close the capital. It is to be transferred as the opening balance in the capital. In the credit side, I have to write down by balance brought forward. Partner's current account, it is to be transferred to the capital account. Partner's capital account debit to partner's capital account. Partner's current account debit to partner's capital account. Any amount that has been reflected through reserves or accumulated profit, like PL credit balance, like reserves balance, it is to be transferred to partner's capital in the profit sharing ratio. And all liabilities are to be transferred to realizations unless otherwise the firm is getting insolvent. The firm is said to be insolvent when the firm is incapable of paying its debt, external debts. Firm is incapable when the firm is said to be incapable when all the partners are insolvent. Tell me, any query, students, regarding this? So I think I can proceed. Next, realizations of assets. Students, assets may be recorded or unrecorded. Recorded means that the partners has already recorded that assets in the books before the process of dissolutions. And in certain cases, certain assets are there, but one can identify that in the event of dissolution. That's are known as the unrecorded assets. But I do not make it complex to you by bifurcating this into two parts. Whatever may be the assets, if you realize it, bank account debit. And as the realizations accounts, as I told you, will result in the profit or loss in the event of dissolutions, the realizations account is to be credited. If the asset has been taken over by the partner, so the amount due to the partner is becoming less. So capital account is to be debited, respective partner's capital account is to be debited to realization account. So these are the treatment for realizations of asset. Now, in case of discharge of external liabilities, discharge or settlement of external liabilities. Now, when you are paying to your creditors your loan to your external party, realizations account debit to bank. If any partner is taking over any third party liability, then the amount due to the third party has been reduced. On the other hand, the amount due by the fund to the capital, to the provider of capital has been increased. So journal entries, realizations account debit to partner's capital account. So these are the step 4 for me. Step 3, step 4. So I think I am following the steps 1, 2, 3, 4. These are the 4 steps that I have mentioned. Okay. Now, there are different types of expenses that may arise in the event of dissolutions. That may be litigations expenses, that may be expenses involving the process of dissolutions. Okay. So what should be the treatment of such expenses? That is depending upon 2 factors. As per the agreement between the firm with the partners, who will bear that expenses? Number 1. And who has been paid such expenses? Number 2. I repeat it. Who is going to bear that expense? This is point number 1. And number 2, such expenses has been paid by whom? If the expenses has been borne by the firm and firm is paying that, so firm is paying, so the cash is going out from the business or your bank balance has been reduced. So bank account is to be credited. And as I told you, realizations account is required for the purpose of analyzing how much is the profit or loss, how much is the result in the event of dissolution. So realizations account is to be debited for that. However, if it is the responsibility of the firm to bear the expenses, however, it has been paid by the partner, so it's the expense of the firm, so realization account is to be debited, but the bank balance of the firm has not been reduced, rather the amount due to the provider of the capital has been increased because they are paying, the partners are paying on behalf of the firm. It's an entity concept. Firm has a separate entity from its partner. So the firm has to pay that amount to the provider of capital. That's why partner's capital account is to be credited. In the third case, if the dissolution, as per the agreement with the partner, if the dissolution expense borne by the partner, but it has been paid by the firm. So the firm is paying on behalf of the partner. So the amount will be collected from the partner, rather the amount is to be debited to the partner, and the bank balance of the fund has been reduced. So bank account is to be credited. And in the last case, it has been borne by the partner, it has been paid by the partner. So in this case, the transaction does not affect the financial positions of the firm. So no journal entry is required in this event. Okay. So these are the 5 steps, and the last but not least step is the how you are going to settle the liability with the partners. Now, partners can contribute in the business in 2 ways. One is by contributing through loan. One is by contributing through capital. Now, students, please, I need your attention in this respect. You have to see, suppose there are 2 partners, A and B. Partners A has a loan account, and partner A's capital balance has a credit balance. So what I am telling you, when the loan account of the partner is appearing in the balance sheet, you have to check the balance of the capital of such partner. If such partner has a credit balance in its capital, then it is to be directly discharged through bank. But if the partner has a debit balance and the loan account is appearing in the balance sheet of such partner, then such loan account is to be transferred to whom? To the provider of capital. That means such partner's capital account by the entry partner's loan account debit to partner's capital. I repeat this point. This has not been mentioned in any of the books right now. I'm just mentioning it, this one. Please, I need your attention. If the partner's loan is appearing in the balance sheet, you have to see whether such partner's capital has a credit balance. If the partner's capital has a credit balance, the loan account is to be paid off. If the partner's account does not have credit balance, it has a debit balance, then the loan account is to be transferred to partner's capital account, not to be paid off at this stage. Can you clarify me why I am telling this to you? Any idea, student? Can you clarify that? Anyone? Let me tell you the answer. If the partner has a debit balance in its capital and such partner has provided the loan, if the partner is very clever, they put more of the money in the event of dissolutions, not in the capital, rather in the loan account. Because the amount due on account of loan is to be paid at first. So they collected their money as they have as such partner has a debit balance in the capital account. They will get that amount later on. They collect that amount at the first because they has a debit balance in their loan account. Debit balance in their capital account. I repeat this point once again. If the partner has a debit balance in the capital account, it implies they have to they have to pay to the firm later on. But they are getting the money from the firm earlier than the other partners as their loan account is appearing in the balance sheet. So as their loan account is appearing in the balance sheet, they have a priority to get the amount from the firm compared to the others. To solve this problem, what the rule is suggesting, if the partners has a loan account, is to be transferred to the partner's capital account in order to square off with the debit balance of partner's capital account. Okay. Next point that I am coming, that is the profit in the event of realizations. It may be profit or loss in the event of realizations. It may be profit, it may be loss. It is to be transferred to partner's capital account in profit sharing ratio. Now, how to close the partner's capital account? Last point. If the partner's capital account reflects credit balance, the firm has to pay that amount to them. If the partner's capital account has a debit balance, the partners has to be pay the amount to the firm. So by this way, all the accounts, even the cash or bank account, gets tallied. So these are the 6 steps that I have mentioned to you. Any doubts regarding this? Any doubts? You can unmute yourself, and if you have any doubts, you can raise your query, students. Any doubts, students? Any query? No, sir.
So just you said that point. Can you please just understand? I can't able to understand that
Which
point,
one?
sir.
Tell me which point.
This one, last one.
Closing of partner's capital
Yes, sir.
account. Okay,
Yes,
my
sir.
screen is clear to you?
Yes, sir. Yes, sir.
Yeah. What I am telling you, after adjusting all the 5 steps, the partners may have a credit balance in his or her account, or the partner's capital has a debit balance in his or her account. If the partner's capital account reflects credit balance, then the firm has a liability to clear the dues. So firm has to pay that amount to the partner. So in that event, partner's capital account debit to bank, this entry is to be passed. But in reverse case, the partner's capital account has a debit balance. That means whatever amount that has been contributed by the partner, they took more than that amount from the firm earlier. So in that scenario, the firm is going to receive the amounts from such partner by passing the entry bank account debit to partner's capital account. And in this way, all the accounts involved in the process of dissolutions will get squared off. Any query?
No, sir. Now it's clear. Thank
Now
you,
it's
sir.
clear. Now I am coming to my topic, that is the insolvency of partner or partners. Now what do we understand by this? Now before coming into the insolvency, I want to tell you who is to be termed as a solvent partner. What I have referred here, that if the ultimate balance of capital account of all the partners reflect credit balance, it implies that the firm is required to make final payment to all partners. What I am telling you, after adjustment of all the items, if you see that the amount is due to the partners only, the amount is not due from the partners, in such a case, the firm is going to pay the final amounts to the partners. And in that case, all the partners are said to be solvent partners. Such partners, all the partners are said to be solvent partner. Now, who is to be termed as a insolvent partner? Concept of insolvent partner or partners. What I am telling you, please, I need your attention, students, here. If any of the partner's capital account reflects a debit balance, that means the partner has taken more money from the fund than the amount that had been contributed by them. So suppose I have contributed 10,000 and I withdraw from the business rupees 50,000. So my account has a debit balance. In such case, in the event of dissolutions of the partner, I have to bring that 40,000 rupees. Now, if I'm able to bring that 40,000 rupees, then I am still to be termed as a solvent partner. But if I am not able to bring that 40,000 from my home, I referred as an insolvent partner. I repeat, after adjustment of all this, if you see any partners has a debit balance in his or her account, then what to do? Then in such a case, the partner, the partner has to contribute to the firms for the final settlement. And in order to contribute to the fund for the final settlement, it may happen the partner is not able to contribute such amount because his private liability is more than the private estate. Then such partner is known as insolvent partner, and the loss that has been arising to such partnership firm is known as insolvency loss or deficiency loss. Any query, students, regarding this? Any query? You may raise your doubts. Any query, students? Please, you can raise your doubt. I proceed. So I think the point is clear to you. That is the insolvency. Insolvent, who is said to be insolvent? The partner has a debit balance. They are going to contribute as a final settlement. They are not able to contribute as a final settlement. In that case, that partner is termed as an insolvent partners, and the loss, the loss that is arising on account of such insolvent partner, the amount which is not able to contribute by such partner is known as the insolvency loss or deficiency loss. Now, how many types of insolvency there in case of a partnership firm? There are two types of insolvency. Number one, personal insolvency. Number two, firm insolvency. Students, please, I need your attentions regarding this, because depending upon the types of insolvency, your solutions pattern will be changed. A partnership firm is said to be insolvent when all the partners are not able to bring the amounts. That means when all the partners are insolvent, the firm is said to be insolvent. If any one of the partner remains solvent, it's a case of personal insolvency. It's not a case of firm insolvency. So we have to discuss both the aspect in case of personal insolvency, in case of firm insolvency. At first, we are going to highlight on the personal insolvency case. In personal insolvency case, the question will arise, who is going to bear such insolvency loss? Okay, which partner is going to bear such insolvency loss? So basically, you have to see two aspects. Number one, just a minute. Number one, whether the partnership deed has covered any provision regarding the bearing of such insolvency loss or not. If the partnership deed is silent, then what we should follow in respect of bearing of such insolvency loss? So I repeat, if in case of personal insolvency, who is going to bear such insolvency loss? It is depending upon the fact whether the partnership deed has mentioned anything, mentioned any clause regarding the points who is going to bear such insolvency loss. This is point number one. And second point, as per the partnership deed, nothing has been mentioned, then what we have to follow? We may follow Section 48 of the Indian Partnership Act 1932, or a specific judicial pronouncement in this regard, namely Garner versus Murray case. Now, if the partnership deed provides any ratios on the basis of which we are going to bear such deficiency loss, then this is nothing that loss is to be borne by the other partners in such ratio. The entry will be the solvent partners capital account debit to the insolvent partners capital account. Okay, in the ratio mentioned in the partnership deed. But I am going to discuss the second point right now. I am highlighting on the second point in case of Garner versus Murray. Settlement as a specific judicial pronouncement in the Garner versus Murray. Now, in this case, 2 points are to be highlighted. Any loss that has been arised in the event of dissolution, such loss is to be brought in cash by the partners corresponding to the individual share, and it is to be brought only by the solvent partners. It is to be brought only by the solvent partners. Now here solvent partner means whose capital account reflects credit balance just at the time of dissolutions. This is the meaning. Okay. So I differ from the meaning of the solvent partner when I discuss regarding who is solvent, who is not solvent in the event of insolvency with the case of Garner versus Murray. What I am telling, solvent partners refers to that partner whose capital account reflects credit balance at the time of dissolution. Okay. Second point, who will bear that deficiency loss? This deficiency loss is to be borne by the solvent partner in the capital ratio. Now, capital ratio refers, if it has been mentioned, it has been maintained under fixed capital method, then the ratio of capital just prior to the dissolutions, and under fluctuating capital method, capital ratio is to be computed as capital account balance as per the last balance sheet plus share of accumulated profit or loss other than the realizations loss plus fresh capital introduced after the last balance sheet date less amount drawn after the last balance sheet date. So what I am telling, it's not so complicated. Under fluctuating capital method, capital refers to that amount which exists just prior to the date of dissolution. The balance exists just prior to the date of dissolution. What does it mean, sir? Suppose the firm is going to dissolve on 30/6/2021. The balance sheet was done on 31st March. So वो 31st March 2021 में कितना capital balance था? With that figure, you have to add the profit during this 3 months period, the amount withdrawn by the partner, the amount that has been contributed by the partner. So वो 36/2021 का पहले कितना capital balance है, that we have to see. Okay. And if the capital is maintained under fixed capital method, then the capital balance appearing in the balance sheet, that is to be termed as the capital in the event, in the context of the amount who is going to bear the loss of such insolvent partner. Okay, so these 2 points has to be highlighted here. These 2 points. Any query, students? Please. Any query? Shall I repeat this portion? Next point I am coming then. Now, what steps to be followed? I mentioned that you have to first draft the realizations account. Second, and how to draft the realizations account, that I have already discussed earlier here. How to draft this realizations account. I discussed all these things. Okay, this you have to follow. After that, what you have to do? The loss on realizations, if any, is to be borne by the solvent partner. Here, solvent partners implies the partners having credit balance in their capital account. Okay. Number 3, amount brought in by the insolvent partners having debit balance. If the insolvent partners is able to contribute anything out of the total due to him, that is to be transacted here. Bank account debit to insolvent partners capital account. Now, the insolvency or deficiency loss, that means how much amount that has not been brought by the insolvent partner, is to be borne by the other partners in the capital ratio. Now, capital ratio that I have mentioned, this way you have to compute the capital ratio. Now, last, how much amount is due to the other solvent partners is to be settled through bank. Any doubts regarding this? So I completed the Garner versus Murray case. Okay. Next I am coming settlement as per Partnership Act 1932. I mentioned one point here. The loss on realization is not required to be bring in any cash for his or her individual share of realizations loss. Unlike the Garner versus Murray case, where the loss is to be brought here, the solvent partner should bring in cash. It is not in the case if the firm is following Partnership Act. Regarding the capital deficiency is to be treated as a loss and is to be borne by the partners in proportion of the profit sharing ratio. I mentioned this, in proportion of the profit sharing ratio. Now, how to account for this? Realization account has been drafted as normal. Amount brought in by the insolvent partners having debit balance. That is, insolvent partners is providing or is contributing a portion on account of deficiency in his account. Then bank account is to be debited, insolvent partners capital account is to be credited. Bearing of insolvency or deficiency loss, partners capital account debit to partners capital account. The first partner, the debit portions of the partners capital referred the solvent partners. They have to bond this loss in the profit sharing ratio. And last, the solvent partners, the amount due to the solvent partners is to be settled. Solvent partners capital account debit to bank account. Now, this is all in the case of individual deficiency. I told you I am going to discuss 2 points. Number 1, personal or individual deficiency. Second one, firm deficiency. These 2 points. Now I am coming to the firm deficiency. Now in this case, what you have to see, the firm is not able to pay even to its third party liability. So in that case, you have to open all the external liabilities accounts separately, and the amount that has not been able to paid by the firm to the third party is to be transferred to the deficiency account, and the amount which is not able to brought in by the partners is also to be transferred to the deficiency account, and deficiency account is to be closed ultimately at the end of the accounting. Okay, so here one more account, multiples here. Certain additional accounts are to be opened, like third party accounts, like creditors, like bills payable, like loans, and one new account, that is the deficiency accounts, are to be opened. Okay, now I'm going to discuss 2 cases here, 2 problems. I'm coming to first one, firm insolvency case. Now students, I just need your attention here, how to understand if firm is it's a case of firm deficiency or not. This is a very major problem. Okay, it has not been explained in any of the books that I am just referring. That what you have to see, you have to check how much amount is due to the creditors, that is a third party. It may be creditors, it may be bills payable, it may be loans, etc. You please see here how much amount is due. Please unmute yourself. 40,000. Yes. So what you have to see, what is the amount available in the hands of the firm? Okay, what's the amount that is available in the hands of the firm? You just go through this. Due to the weak financial condition, the firm decided to dissolve the firm. The sundry assets realized 10,400, expense on realizations 400. All the partners are insolvent. X could not provide anything for his private estate. However, Y and Z can provide 4,000 and 10,000 respectively. Now you please take your calculator. Take your calculator. I am just going to analyze whether it's a case of firm insolvency or it's a case of individual partners insolvency. How much bank balance you have right now? You have to see how much bank balance you have. Please tell me. Anyone tell me? I mean, I just reflecting in this side. How much bank balance you have?
1 lakh. 1 lakh.
Bank balance is how much here? 1 lakh. Just check here. Just a minute. This is bank balance in the asset side. How much bank balance you have? None. No bank balance is there in the asset side.
No bank plans. So sorry,
Yes,
sir.
zero. So if the bank balance is there, you have to start with that figure. Okay. So here 0 is the bank balance. How much have you realized by realizations of asset?
10,400.
So you add this figure 10,400. How much amount you have to bear on account of realization?
400.
So net balance available to you right now?
So
10,800.
Not 10,800. You have 10,400 by selling your assets. You have to pay the realizations expenses of 400. So net amount available to you is how much? I collected
10,000, sir.
by selling my assets. Yeah, 10,400 minus 400, 10,000. This is point number 1. How much Y can contribute?
4,000.
And how much Z can contribute?
10,000.
So 10 plus 4 plus 10, how much is there?
24,000.
24,000.
How much
24,000.
you are going to pay to your creditors?
40,000.
40,000.
So is that 24,000 sufficient to cover this 40,000?
No, sir.
No, sir.
So it's a case of firm insolvency. I have to test this at first. It's a case of firm insolvency. I mentioned that here. Solvency status of the firm. It's a case of firm insolvency. Any doubts regarding this? If it's a case of firm insolvency, then you have to open your external liabilities account separately. You have to open your external liabilities account separately. This account is to be opened separately. I opened creditors account separately, that's why. By balance brought forward 40,000. Doubt, students? This is point number 1. Second, after seeing that, I told you all the assets are to be transferred to the realizations account debit side. There is only one items in the name of sundry assets, so I transferred this in the realizations account debit side. Now PL account debit balance, it's an accumulated loss. It is to be shared by the partners in profit sharing ratio. So I share this to PL account in the profit sharing ratio between X, Y, and Z. Partners capital, there are 3 partners, 30, 20, and 10. So these 30, 20, and 10, I have transferred as by balance brought forward 30, 20, and 10. Partners capital opening balance. Now I have opened the creditors account separately. Creditors account separately, 40,000. Now how much you are going to realize? The assets are realized for 10,400. So you know that for every adjustment you have to pass a journal entry. So I am passing the entry bank account debit to realizations account. So I posted in the credit side of the realizations and I posted in the debit side of my bank. Next, expense is how much? Is 400 rupees only. So you paid the expenses. So realizations account debit to bank. It has not been mentioned who is going to bear. Unless otherwise mentioned, you should take the assumption that it has been paid by the firm and it is the duty of the firm to pay that expenses. Okay, 400. Now, after posting all this, I can calculate the loss on realization. This is my loss on realizations. I transferred such loss to the partner's capital in the profit sharing ratio. Now, what we have to see, I have to see how much Y and Z can contribute. You just see the amount that is available in the bank is not sufficient. Only 10,000 rupees is available sufficient to pay off your creditors of rupees 40,000. Now you have to check how much amount that can be available from the partners. So you are seeing from here, X could not provide anything from his private estate. However, Y and Z can provide 4,000 and 10,000 respectively. So what I am telling you, I am just bringing that amount through Y and Z, 4,000 and 10,000. And after this, I am just posting that item in the bank two partners capital account Y and Z. So total balance is available in the hands of the firm is 10,400 plus 14,000 minus 400. The difference amount is to be going for the final settlement of the creditors. I paid that amount to the creditors, 24,000. So I'm not able to pay that 16,000 rupees. So this amount is to be transferred to where? To the deficiency account by sundry creditors 16,000. So as you are not even paying to your third party liability, so you cannot clear any amount due to your partners. So I'm just going to close the partners capital here by deficiency account balancing figure to deficiency account balancing figure. Two are appearing in the credit side of the partner, one is appearing in the debit side of the partner. Now I'm posting this figure in the deficiency account. This way I have to close the deficiency and deficiency balance account will be tallied. Any query, students? I want to repeat. I may repeat if you want that. Last case that I am coming. There are four partners P, Q, R, and S. Okay, this is the balance sheet. Now, what point that I am highlighting here? This point. I want to highlight this point only. R became insolvent and nothing was realized from his private estate. Applying the principle laid down in Garner versus Murray, prepare realizations account, partners capital account, and cash account. Now I solve this question. I find out my realizations account is 1,300,000. I shared such loss between P, Q, R, and S. Okay. This is the loss amount. What I am telling you, as you have to see the partners who is solvent here. Here you can check R become insolvent and nothing was realized from his estate. So who are the solvent partners? The solvent partners are P, Q, and S. Okay. So realizations loss brought in by them this amount. Okay. Next point that I am highlighting here, you just see here, I just after completion of all these things, what I have done, that R is insolvent. So how much is the amount due to R? It's 21,600. This loss is to be borne by whom? This loss is to be borne by the solvent partners having credit balance in their account in the capital ratio. What I have done, just see, these are the items. I just mentioning this. These are the items I mentioned in the gray that is appearing in the balance sheet before the point of dissolutions. I adjusted all these things. After adjusting all these things, what I saw, that only P and Q has a credit balance. Only P and Q. Only P and Q. So P and Q will bear such insolvency loss in the capital ratio. That is 2,16,000 is to 1,44,000. The loss amount comes to you 12,636 and 8,424. So this is the amount of loss. So as this is the amount of loss, I transferred that loss to P and Q from here. Okay. The ultimate amount due to P and Q will be reduced by the such loss, and this 2,03,364 and 1,35,576 is to be paid to them. Whereas we have to collect the amount due from us of rupees 6,000. I think it's 7 o'clock. The time is over. So if you have any queries, doubts regarding this, you please raise your query, doubts. It's thanks to all of you, my dear students. Any doubt, students? Shunita, I think the portion has been covered.
Okay, sir. Students, if you have any query, just within few minutes, you place your query to sir. Otherwise, we will close the session. Okay, sir. I think no students have any query. Sir, principal ma'am have left a message that she, due to some urgent work, she was not able to join. So she will be talking over you with on telephone. And we are now, sir. I think the session was clear to you all students. Sir has made a wonderful effort and presentation for explaining you all the concept on insolvency of the partner. So we are thankful to you, sir, for your lecture session of to the students of the third semester. And I shall, at the end of the session, I shall request Professor Anu Ojha to deliver her vote of thanks to close the session. Over to you, Anu.
Thank you, ma'am, and thank you, sir. So, on behalf of THK Jain College and from the Department of Commerce, we would like to deliver a vote of thanks to our respected sir, Soumya Mukherjee, sir, Assistant Professor of Maharaja Manindra College, and for such an informative lecture session for students for third semester on the topic of insolvency of a partner from a partnership account. We would like to express our gratitude to our respected principal madam, Dr. Mausami Sin Sengupta, and our departmental in charge, Dr. Asad Kumar Mandal, for giving us the opportunity for organizing the session for the student learning benefit. We would like to express our thankfulness to all the faculty members of department and the technical staff member for conducting the session smoothly. And at the end, we would like to thank you, students, for participating in this session. Thank you all for your cooperation. Thank you, sir. Have a good day, sir.
Thank you very much for your
Thank-
patient hearing, students. Once again, thank you very much to all the faculty members from my side also.
Thank you, sir. We will again be waiting for any other lecture session in the coming semester too.